Welcome to The Explainer. Today, we're diving into the financial autopsy of RH's Q1 2026 results. If you've ever tried to slog through an SEC Form 10-Q, you know they're incredibly dense, packed with legal jargon and endless tables. But we're going to bypass all that noise and extract the exact story those numbers are actually telling us about one of the biggest names in luxury retail.
So here's our roadmap. We'll kick things off with their surprising Q1 loss, then dissect the income statement, check out their cash flow and foundation, and finally, wrap up by exploring RH's massive real estate empire.
Okay, let's jump right into part 1, a surprising Q1 loss.
You know, when you think of RH, you probably picture those massive, meticulously curated galleries, right? High-end furniture, crystal chandeliers, just an overall aura of absolute premium living. They're a luxury lifestyle titan. But looking at their recent filing, it tells a wildly different, honestly pretty dramatic tale about their current financial health. Which leads us straight to the multi-million-dollar question. How exactly does a brand selling premium, high-margin lifestyle goods suddenly find itself slipping into the red? The bottom line here is just stark. RH swung from an $8 million profit in this exact same quarter a year ago to a shocking $13.6 million net loss for the first quarter of fiscal 2026. I mean, wow, that is a massive reversal in just 12 months. To figure out why, we really need to look under the hood.
That brings us to Section 2, dissecting the income statement. So, starting at the top, revenue saw a slight dip. They brought in roughly $814 million in Q1 of 2025, and that ticked down to about $800 million in Q1 of 2026. Now, a $14 million drop is definitely a headwind, sure, but for an $800 million quarter, it's really not catastrophic on its own. So where did the real damage happen?
But what's fascinating is how that relatively modest revenue drop absolutely crushed their earnings per share. It plummeted from a positive 40 cents per share a year ago all the way down to a 73-cent loss per share today. That tells us immediately that their underlying costs and expenses ate up way more of their revenue than they did last year.
Here's the absolute kicker. If you look at their operating income, they actually made $34.2 million from their core business of, selling goods. But right below the operating line, there's a massive $52.6 million interest expense. Think about that. That single expense completely swallowed their operating income, dragging them straight from the black into the red. They are carrying a seriously heavy debt load that just requires constant feeding.
Let's move on to Section 3, cash flow and foundation.
Now, despite the income statement looking a bit messy with those losses, the cash flow tells a surprisingly different story. The filing shows they still managed to pull in $52.5 million in positive cash from operations. You're probably wondering, wait, how do you report a $13.6 million net loss but actually generate over $50 million in cash? Well, it all comes down to non-cash expenses. They had over $38 million in depreciation and amortization, plus another $27 million in non-cash operating lease costs. These totally lower the profit on paper, but they don't actually drain the bank account today.
And that operational stability? It's heavily anchored by the fact that they're sitting on over $802 million in merchandise inventory. That is a massive physical cushion. They have the goods ready to sell, now they just need to actually move them out the door without racking up too much more debt.
Which perfectly segues into our final section, RH's real estate empire.
We really need to talk about the sheer scale of their physical footprint. With 75 immersive galleries, 43 outlets, and even a dedicated guest house, RH is operating almost as much as a high-end real estate developer as a traditional luxury retailer. They aren't just renting storefronts in your local mall. They are taking over massive, standalone properties and completely transforming them into architectural landmarks. To really grasp this expansion strategy, we have to quickly translate some SEC jargon buried deep in the footnotes. Variable interest entities, or VIEs. Now, stick with me here. Think of a VIE as kind of like a specialized joint venture. It allows RH to partner with real estate developers, hold a controlling financial interest, and direct the property's development without necessarily having all the voting rights.
RH leans heavily on these VIEs to fuel their crazy growth. For instance, they use what they call member LLCs to partner up with developers and fund those massive gallery transformations we just talked about. They also have Aspen LLCs, which were explicitly formed to acquire, develop, and sell real estate projects in Aspen, Colorado. So yeah, they are actively co-developing the very real estate they operate in. And believe it or not, it can pay off brilliantly. The filing reveals that in March 2025, one of these Aspen LLCs actually sold a property, returning a cool $15 million directly to RH. That included repayment of a promissory note, a return of their capital, and millions in pure return on investment. It's honestly a fascinating secondary revenue stream for what is, at its core, a furniture retailer.
But, and this is a big but, building this kind of empire comes with a staggering foundation of debt. This brings us right back to those huge expenses we talked about earlier. They're carrying a combined $1.59 billion in lease liabilities. That breaks down into $844 million in operating leases and $756 million in finance leases. That right there is the heavy financial weight of running 75 massive luxury galleries.
And the financial pressure, it's immediate. Just look at the timeline. They owe hundreds of millions in lease payments over the next few years just to keep the lights on in these luxury spaces. They're on the hook for nearly $174 million for the remainder of 2026 alone, and then nearly $215 million in 2027. That requires a lot of high-margin couches to be sold, to say the least. Which leaves us with a pretty provocative thought about their financial position heading into the rest of the year. We've seen the $13.6 million loss completely squeezed by interest and expansion costs. Yet we've also seen their genuinely strong operating cash flow, that massive physical inventory, and their really innovative real estate plays through those VIEs. So, what do you think? Is this heavy debt load simply a temporary growing pain as they build out an unrivaled luxury empire? Or is it a permanent liability that's going to continually drag down their bottom line? Keep a close eye on those interest expenses in their next filing. Thanks for joining me on this explainer, and we'll catch you next time.